Hello and welcome to the Tax Roundup for March. We're going to take a look at legislation before Parliament, which is the Netflix tax, but this bill also contains important changes to farm management deposit schemes. Mike's going to take us through an interesting case that looks at why the sale price and the market price may not be the same for accessing the small business CGT concessions. We're going to look at the Tax Practitioners Board view on cloud computing. But first up, across to Mike, who's going to take you through those changes before Parliament right now on the small business rollover relief. Across to you, Mike.
One of the major developments for this month is the release into Parliament of a bill containing the proposed new rules for small business rollover relief. Now, just before Christmas, we had draft law being released, and we discussed that at the time, and it seemed like things were moving in the right direction, but there were a few little gaps. There were some things that didn't quite sit right. But now that we've got this bill introduced to Parliament, a lot of those things have been fixed up, which is really great. Now, remember, the rules will not start till 1 July 2016. They're still with Parliament, so they're not law yet, but we're getting pretty close. Now, just to bring you up to date on where the major changes have been from the draft version that we saw last year to the current version that's with Parliament. One of the things that was a bit of a concern originally was, in order to access this small business rollover relief, and remember this is aimed at small business taxpayers, was that they would have to pass both a turnover test, so a small business entity $2 million turnover test, and also a $6 million net asset test. The $6 million test has now been scrapped, so the parties involved in the transaction will need to satisfy a small business entity test based on turnover, which is generally an easier thing to do. You don't have to necessarily go out and get valuations and things done. So that's one good step in the right direction. One of the other issues around the draft version was the entity receiving the assets was not allowed to provide consideration if they wanted to get the rollover relief. Fortunately, that has also been scrapped too. So we can have shares being issued, units being issued, liabilities being assumed by the purchaser, cash being paid by the purchaser. There is now a lot more flexibility in how it is structured from a commercial point of view in order to get the same tax outcome. So again, that's quite a good thing. A couple of other things that have changed. Previously, the draft version said that when the assets are transferred over to the new business entity, the CGT discount period would not be reset. So you wouldn't have to start that 12-month period again. Now, the current version of the rules is the opposite of that. It says you do start the CGT discount testing period again. So the assets get transferred into the new entity, you start your 12-month testing period again from that point onwards. When we come to the 15-year exemption, it's actually the other way around. The draft version of the law suggested that when the assets are transferred, that would reset the ownership period for the small business 15-year exemption on future sale. That's now changed so that the 15-year ownership period can basically stretch back to when the previous owner bought the asset. So you could have the company running the business, owning the assets for 10 years, transfers those assets into a trust, which will then run the business for another 5 or 6 or 10 years. If the assets are then sold, you can combine the ownership period for the trust and also the previous ownership by the company, as long as a small business rollover relief was applied to that transaction in the middle. So again, pretty good news for small businesses. They can maintain access potentially to the 15-year exemption without having to restart that 15-year ownership period. Now, there's some other changes that have gone through. We probably wait and discuss those on another day, but remember, the start date is not till 1 July 2016, so it's not like you can use the rules yet anyway. If you do have clients who are thinking about restructuring over the next little while, it definitely is worth throwing these proposed new rules into the mix to see whether they can give a better outcome compared with other rollover reliefs that are there at the moment, or the normal small business CGT concessions. But we'll of course let you know how things progress through Parliament and what happens when the rules are actually finally passed.
Continuing with legislation, Rae's going to take you through that bill on the Netflix tax and also those changes to farm management deposit schemes.
A bill was introduced in February in relation to GST and digital imports, and also farm management deposits. Now, in relation to the GST issues, we've been hearing about this for quite some time. These proposed changes are going to take effect from the 1st of July 2017, and it's in relation to those suppliers overseas who are currently selling into the Australian market the downloads of movies, music, apps, all those things that now people don't really think much about GST on them. They will all, in the future, be required to compulsorily charge that GST and remit it to the tax office. And once again, those changes are due to take effect from the 1st of July 2017. Now, with the farm management deposits, this is a little bit more interesting. These changes are due to take effect from the 1st of July 2016. So 3 major changes is: 1, the increase in the farm management deposit amount from 400,000 to 800,000. The second thing is that if there is a severe drought, the taxpayer who made a deposit will be able to pull it out within 12 months in the case of that severe drought without impacting the prior deductibility of that deposit. And also, those farm management deposit accounts can be used as an offset against other loans and financing in relation to assets that are being used in that primary production business. So, for example, the farmer who has taken out a loan to purchase plant and equipment that they're going to be using in their primary production business, they can now use that farm management deposit account to reduce down the interest expense they will be paying in relation to that loan. So good news there for the farmers.
In cases this month, Michael is going to take a look at why the sale price and the market price may not be the same for accessing the small business CGT concessions.
Now, a really interesting case that's come through this month is Miley and the Commissioner of Taxation. It's an administrative appeals tribunal decision. Now, the fundamental issue in this case was the market value of an asset the same as the sale price received by the taxpayer for that asset? And the reason why that was so important was because the taxpayer was trying to utilise the small business CGT concessions and was relying on the $6 million net asset test. Now, what happened here was we had a taxpayer who was one of 3 shareholders in a company, and the shareholders owned their shares 1/3 each. They collectively agreed to sell their shares to one purchaser, and that purchaser was going to buy all their shares for just over $17 million. Now, what that meant was that the taxpayer, for their 1/3 shareholding, would receive about $5.9 million. Now, if you were to put $5.9 million into their maximum net asset value calculation, add their other assets in, there was a pretty significant risk that they would go above the $6 million threshold. There was a separate issue that was in the background where maybe there was some dispute over some liabilities that might bring that number down, but the fundamental issue was the number to put into that calculation $5.9 million, or was it some other number? The taxpayer argued it was some other number. They went and got a valuation opinion where the valuer said, well, actually the market value of those shares just before the contract was signed was something less than $5.9 million. It was actually around $4.9 million. The reason for the difference was effectively a premium that the purchaser was paying to take control of the company. So the valuer said, well, the purchaser is maybe prepared to pay more because they're not only holding 1/3 of the shares, they're buying 100% of the shares. So they're going to take control of the company. And there's a premium that is attached to that because they have total control over what happens with the company from then on. So the valuer said, well, I'm only valuing the 1/3 shareholding that this particular taxpayer has. They don't have control of the company. They've only got a 1/3 interest, so we should apply a discount. So while the proceeds might be around $5.9 million, we take a discount off that because there's no effective control of the company for that taxpayer, and that's how you ended up at a $4.9 million number. The maximum net asset test says you include the net value of assets, which is based on market value, just before the CGT event. So we end up with this argument as to what is the market value of those shares. Is it the sale price where the transaction was conducted at arm's length? They weren't related parties, so it's an arm's length transaction. Or was it this lower number where we've applied a discount for lack of control? The AAT agreed with the taxpayer and said it's completely reasonable to factor in that discount because the taxpayer didn't have control of the company. So really interesting decision. The AAT said the sale price, where it's an unrelated party transaction, is indicative of market value but not determinative. So yes, you take it into account. It's certainly a factor to take into account, but the sale price is not necessarily the same as market value just before the time of the CGT event. This is something that'll be quite interesting to a lot of people where they're around that $6 million mark, particularly where it's sale of shares in a company or units in a trust, where the taxpayer themselves don't have that control interest, and it may well be reasonable to apply a discount to what would otherwise be, I guess, the sale proceeds for those assets. So there certainly would be situations where this would be relevant. It'd be interesting to see if this goes further than the AAT, but for the meantime, a win for the taxpayer, showing that sale price is not necessarily market value.
The impact of cloud computing is a really interesting issue right now, and one the Tax Practitioners Board is having a very close look at.
The Tax Practitioner Board are finalising their position in relation to tax agents and their use of cloud-based technology. One of the concerns they have is in relation to the protection of that information for the taxpayers, and also how the taxpayers may have consented to that information being stored in the cloud. Now obviously any tax agent would have to make sure that their engagement letters cover over not only that the information will be stored in the cloud, but that their clients specifically consent to them being able to do so. And don't forget that if that information is in an application that's domiciled outside Australia, then that other jurisdiction's legislation would apply in relation to how that information could be accessed and used. A very important reminder for tax agents to make sure they've not only covered that off themselves, but how they communicated that to their clients and have the clients specifically consented to do that. Now in the Knowledge Shop's range of engagement letters, that is all covered off in the terms of the engagement letter, so it might be a timely reminder just to check if you're not already using the Knowledge Shop engagement letters, whether or not the ones you do use are covering all those issues and that you are protected.
And that's the tax roundup for this month. Remember, if you're a member of Knowledge Shop, we'll be releasing all the FBT materials very soon. And if you're not a member of Knowledge Shop, it's never too late. Give Julie a call on 1800 800 232, and we'll look forward to speaking to you soon. See you next month.